Welcome to your April 2022 monthly market report for real estate in the Phoenix metro area. I'm Beth Riebenstorf, and I'm happy to walk you through the important topics regarding our housing market today. Let's start with the one everyone's talking about. What impact will rising mortgage rates have? How will it affect prices? And inventory that's been so low. So let's take a look at the historical data and see what happened historically when mortgage rates were rising. Here's the current situation. Mortgage rates are on the rise. The data from Freddie Mac goes back to the very beginning of the year, where mortgage rates started out at 3.11% for the average 30-year fixed, and they've steadily climbed since then up to 4.76%. You may be seeing something slightly higher or lower in your market. This is Freddie Mac data looking back at the previous week, so as of the very end of March 2022. So, a lot of people are asking why. What's driving the increase in interest rates? Freddie Mac says mortgage rates are likely to continue to move higher throughout the balance of 2022. Although the pace of rate increases is likely to moderate, much of the increase in rates in early 2022 is in anticipation of what will happen later this year, especially with Federal Reserve interest rate policy. Basically, as the Fed rates rise, mortgage rates tend to follow that. So, what does that mean for home prices? Some people think that when rates go up, prices go down. Well, let's see if that's been the case historically. This shows the impact of rising rates on home prices when mortgage rates rose by more than a percentage point, going back 30 years to October of 1993. Now, it shows an average of about 8% home price appreciation as mortgage rates were rising by more than a percentage point. So, rising rates have not had a negative impact on home prices. So, what about home sales? Here we'll add in home sales for the same period of time. It shows an average of a decrease of 11% in home sales as prices were rising. Now, it's common as rates rise, buyer activity would be reduced, and it sometimes prices some folks out of the market entirely. But it's important to look at some of the details. For instance, October 93 to December 94, mortgage rates increased 2.38% to a final rate of 9.2%. That is a fundamentally very different housing market. No experts are predicting anything even close to 9.2% interest rates. So, what we start to see is that rising mortgage rates, well, they don't have a huge impact on home sales. That brings us to another very important factor, inventory. Today, what we're seeing is drastically low inventory. So let's layer in the inventory data. Here's a look at months inventory, which is only available going back to 2003, 2004 for this series of data. It was 5 months of inventory, 4.5 months, and then 4.8 months supply of inventory. Again, very different inventory level than today. In 2005 and 2006 and 2012 and 13, where there was a negative impact on sales, there was plenty of inventory, unlike what we have in today's market. NAR is saying that while higher short term interest rates will push up mortgage rates, we expect some of this impact to be mitigated eventually through lower inflation. Thus, I expect the 30-year fixed mortgage rate to continue to rise, although we aren't likely to see big jumps that occurred over the past few weeks. And here's what Freddie Mac is saying. History suggests that when rates rise, there's an initial bump in home prices as many move quickly to buy a home before rates increase further. But after that period, home prices slow. Freddie Mac analysis shows that a 1% increase in mortgage rates results in home price appreciation that is 4 percentage points lower. For instance, a 1% increase in mortgage rates would change home price growth from 11% to 7%. So the rise in mortgage rates is expected to slow some of the frenzy, but that is not depreciation. It's still appreciation, just at a slowed rate of appreciation. Mike Simonson from Altos Research sums it up well. We keep watching for it, but there are absolutely no signs of market slowdown anywhere in the data. If anything, we're seeing the market continue to heat up. A look at buyer and seller traffic patterns shows that the rise in interest rates is not slowing down buyer traffic across the country. A few states are showing stable buyer traffic, but as we head into the spring market, very, very strong buyer demand, as you can see in the dark blue. On the other side of the coin, the seller traffic, you'll see the white, almost gray looking, those are very weak, and most of the country is in that light blue with weak seller traffic. And that picture says it all. It's the story of extremely low inventory and strong buyer demand, which is what keeps that upward pressure on prices. So, if there's any sort of good news relative to sellers, it's that in March, active listings increased in this country for the first time in 6 months. Going back to the fall of last year, around September, active listings, well, they began to fall. All of those listings were being consumed by the buyers in the market. And we're starting to see a tick up, very slight, but nonetheless a tick up. So we're at 382,000 active listings for March, according to Realtor.com. And these are just actives, they don't include any pendings. March of last year, about 471,000 active listings. So just about 100,000 fewer active listings this March compared to last year. The increase from 376,000 in February to 382,000 in March, that is noteworthy, and we'll keep a close eye on that. Here we have a look at showings as measured by showing time. Showings actually exceed where we were during the pandemic. Those scheduling appointments to see homes are well ahead of before the pandemic and well ahead of during the pandemic. This is from the Case Shiller report, and it shows the picture for year over year monthly price appreciation. Each month continuing to increase, with January at 19.1%, well ahead of historical appreciation. And to wrap things up, a couple more views that show what's happening. First is active listings. This graphic shows active listings as compared to new listings going back to August of 2021. The blue are active listing each month, and the green are new listings that are taken during the month. All through the fall and coming into the new year, active listings outpace the new listings until March, where new listings actually outpace the active listings, meaning as soon as something comes onto the market, it sells, and it sells right away. And this look at single family housing units completed, well, this tells a story of why it's so hard to find a home right now and why prices have risen the way that they have. For 14 straight years, we've been below the 50-year average in builds, going all the way back to the 70s. The lack of available homes coming to market has constricted supply. And lastly, this shows home ownership as a hedge against inflation. When in an inflationary economy, you want to be invested in hard assets that outperform inflation. So, going back to the 70s, the blue bar is the inflation rate, the green bar is home price appreciation. Most decades, home price appreciation has outperformed inflation, the exception being the 2000s. And of course, this was during the housing crisis. But for many of the decades, housing has well outperformed inflation. That's something to keep in mind with inflation and continued low inventory. Even with all this data, many people are understandably concerned about prices. Will homes lose value? For all the folks that are waiting on the sidelines right now for home prices to go down, here are what 7 experts are predicting. On average, they put home price appreciation at 6.7%. Now, there is nobody forecasting prices to go down. The lowest is Zelman at 3%. CoreLogic is saying 9.6%, and the others are all in between. With this very competitive spring market, the competitive year, and appreciation well above what we've seen in historical years, well, these predictions are likely to increase as the year unfolds. We'll see what next month brings, and you can count on us to share all that information. We'll talk with you next month.